From the point of view, looking at what's going on in precious metals, gold is just moving sideways. Silver's got, a nice bid under it, actually. I mean, it really feels firm. China, in my view, has accumulated an awful lot of silver. It's been stockpiling it over the years, so it's been controlling the market. But I suspect that's changing. And the thing that's interesting is that perhaps with a very quiet change of policy, I mean, we've seen it with rare earths, very good example. But we're now finding that, silver, platinum, and so on, I mean, suddenly there's a behavior going on there, which we're not all that familiar with.
Over the past month, the silver market in some countries has been feverish as money flows in strongly, causing the price of this commodity to set new high records continuously. Data is scarce, but since Russia revealed a plan late last year to add silver to its state reserve fund for the first time, the silver price has outperformed gold. But if the Russian central bank is quietly building a silver stockpile, as is the case, then it is possible to see other banks aligned to Russia following its lead. Seasoned economist and former banker Alasdair Macleod notes that while gold trades sideways, silver stays firm with strong demand. According to him, in 2024, China's silver exports declined, suggesting a subtle policy shift and reduced market control. The price of silver has already surged by over 35% since January, following a 21% gain in 2024. The most optimistic projections now point to targets of $45 or even $48 an ounce. Industrial demand remains solid, with a clear upturn in China and Europe. While reflecting on trends, Macleod highlights a sharp drain of over 20 million ounces from the Bank of England and LBMA vaults. He mentions that COMEX, stands for delivery, has surged nearly 4 times, signaling a shift from paper to physical settlement. Macleod warns that gold lease rollovers may end as central banks reclaim bullion, threatening the paper gold system. With strong Asian demand and eroding trust in paper gold, a major price reset could strike by late 2025. The COMEX delivery issues of 2020 illustrated this dynamic, with physical gold commanding significant premiums over paper gold prices as investors sought the security of direct ownership without counterparty risk. An unexpected spark of optimism is rippling through the precious metals market as gold's ascent ushers in renewed confidence among investors. Before we dive into Alasdair Macleod's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
I recognize this on my Substack, along with fellow writers at Substack. They say, well, this time of year is always quiet. You can sort of market and do this and do that and all the rest of it, but forget it. Nobody's interested. And that's where we are. So this is why you sell in May and go away. It's not necessarily because the market's going to collapse. You sell in May and go away because nothing's going to happen until you come back in August, late August, early September. And I think we've got the same syndrome now. But this situation is so stretched that I don't think that it can go much beyond the later stages of this summer. It is so stretched. And interestingly, Andy, from the point of view, looking at what's going on in precious metals, gold is just moving sideways. Silver's got, a nice bid under it, actually. I mean, it really feels firm. And I look forward to your market analysis on this. But if you look at both those precious metals, they should be coming off in the summer months, basically, because the establishment will want some cheap stock or to market on their shorts or whatever it might be. It could happen yet. There's no sign of it. It's just remarkably firm. And I just get the feeling that anything coming into the market is just taken. And the other thing I did notice is that in 2023, China exported an awful lot of silver. And to my mind, was suppressing the market. And the thing that was interesting is that amongst the largest takers of this silver were places like Hong Kong, Singapore, and London, which I would regard as predominantly financial centers rather than photovoltaic manufacturers. Last year, 2024, these financial centers dropped off. There was still a sort of net export from China. I mean, there's no doubt that China, in my view, has accumulated an awful lot of silver. It's been stockpiling it over the years, so it's been controlling the market. But I suspect that's changing. And the thing that's interesting is that perhaps with a very quiet change of policy, I mean, we've seen it with rare earths. Very good example. But we're now finding that, silver, platinum, and so on, I mean, suddenly there's a behavior going on there, which we're not all that familiar with. There is another aspect to this, which I want to explore a little bit with you. We had an announcement, I think it was a sort of, monthly commentary coming out of the ECB about what had happened earlier this year with, the premiums on COMEX and how it sucked in bullion and all the rest of it. And it was quite an interesting article, the way it was written, because it was actually trying not to say too much to upset the markets, if you like. That's the feeling I got. But the one thing they said, the reason that we're worried about this is that Eurozone institutions, their derivatives position in gold have increased 58% compared with the previous quarter. Now, this is interesting because tied with this, they mentioned the stands for delivery. Now, I haven't seen anyone else talk about this. I've been talking about it for some time, and we've talked about it together. But I thought I'd run some numbers on this. I mean, the stands for delivery are very important. I mean, basically, my hypothesis is that when it became possible that Trump was going to introduce flat 25% tariffs on all commodities, all imports, the whole lot, the problem for COMEX, operators in COMEX, is that they had stand for delivery obligations. And these stand for delivery obligations were accelerated. Now, nobody really notices this, but they are absolutely huge. Now, I know that the exchange for physical are even greater, but, we don't know whether that's one way or the other way, and it can be both ways. But, we've got hard evidence with stands for delivery. Interestingly, the Bank of England's vaults lost 14,048,000 ounces between the end of October and the end of April. Yeah. On top of that, the LBMA lost a further 7.7 million for a total of 20,751,000 ounces.
Wow, that's big.
The stands for delivery in that time, interestingly, were a bit over 22 million and 36,500. Now, you can't necessarily say that these figures are meant to match, but you can see that you've got a problem on one side and you've got a problem on the other side. Now, part of the problem, of course, is that the stands for delivery have increased at a faster rate this year so far than they have in recent years. I mean, I think I'm right in saying that between 2021 and 24, stands for delivery were around about 2,100 tons. This year so far, we're running at the rate of an annualized 1,500 tons. So we're running at close to 4 times the rate, if you like. The interesting thing, and this is something which I think the ECB is actually worried about, is that all this stuff disappearing from London, how's it going to get back? Because the point about an arbitrage is you do one leg and then you do another leg. And what you might do is you might protect your position by, say, taking out an out-of-the-money call option just in case the price rises too much. But if you've actually, say, taken 20% premium, which at one stage you could do by literally begging, borrowing, or stealing bullion from one centre and selling it into another centre, you've got to get it back because you've got the obligations from where you got it. And this is the interesting thing, because the Bank of England, as I say, you had leaching out from. You had 14,048,000 ounces. Now, this is interesting because I don't believe that bullion banks and hedge funds, whatever, store much bullion in the Bank of England. It's predominantly central banks. Would you agree with that, or am I wrong?
No, okay. You're right.
So what that means is that, the system whereby the Bank of England turns around to a leasing central bank and says, don't worry, you'll earn 1%, whatever the figure is, and it'll, pay for your storage costs, which is lovely. It's lovely for us, lovely for you. And we have a book entry transfer system. So, the bullion stays here, and at the end of the lease, you'll be able to get it back. It's gone. So what happens? I mean, put yourself in the position of a central bank. You say, well, I don't like this. Where's my gold? The liquidity in the paper market is backed up by leasing and a rehypothecation of leases and all the rest of it. I would be very surprised if the central banking community are prepared to extend their leases anymore. I think they're saying, no, we're not doing this anymore. And some of them might indeed be saying, we want to store our own gold. Let's have it back. So this is fatal, really, for the paper market. And I suspect that the second half of this year, we're going to see this. Now, the problem you mentioned sort of wider quadrillions and all the rest of it. The problem, of course, for the derivatives market is that many of the actors in the bullion markets are also acting in other derivative markets. So if you've got counterparty risk escalating in bullion markets, then you've got counterparty risk escalating everywhere. And this is going to be actually, well, let's put it this way, as the Chinese would say, interesting.
Market expert Alasdair Macleod warns that Trump's escalating tariffs and massive spending proposals are economically destructive and eroding confidence in the US dollar. Foreign investors, already losing value on US assets, may increasingly flee to their currencies or gold. As central banks shift away from dollar-based credit and the Fed shortens debt maturities, Macleod sees a deepening credit crisis ahead, possibly accelerating in late 2025. The US dollar is also losing value now relative to other currencies, having fallen about 9% since the beginning of the year amid President Trump's trade war. The question isn't if the dollar loses supremacy, it's when. The challenge for Washington now is whether it will reform and share the financial order or cling to outdated privileges until the world has moved on without it. Just this week, Donald Trump threatened increased tariffs of 10% for un-American BRICS nations and any countries aligning themselves with the 10-member bloc. Geopolitical risks, including U.S. tariff threats and BRICS' push for a non-dollar payment system, have amplified demand for gold as a hedge against financial instability. Let's get back to the interview.
With respect to the tariff situation, I saw a chart, I think it was in the Telegraph this morning, which showed that the level of tariffs are now higher than they were at the time of Smoot-Hawley. We've just completely reversed all the progress towards free trade. But of course, we don't actually know the figures because, Trump keeps on changing the narrative. And, he's obviously not getting the agreements in on time. So he's sort of extending it, and throwing out things like, we're going to tax copper 50%, import, come on. This is economically destructive. It really is. And at the same time, he produces his big, beautiful, wonderful bill, another $3+ trillion of spending. The man's a spendthrift. And at the same time, he's telling the world that the dollar should be lower and interest rates should be lower and Jay Powell should be sacked because he's asleep at the wheel. This is thoroughly irresponsible, particularly when you bear in mind that foreigners own this is according to Treasury TIC figures, just a short $40 trillion and underlying deposits and investments. So what do? Already you've seen the dollar go down and the chart looks terrible. So, we don't need to talk about fundamentals. But from a foreigner's point of view, he might be doing quite well on his Nvidia, which are now worth $4 trillion or something, capitalization. But apart from the odd spot like that, his $15 trillion in equities, his holdings of US government debt and agency debt and corporate debt and deposits, he's losing on the whole lot. What does he do? A foreigner's risk-free position is to get into his own currency because that's what he accounts in. That's what his profits are rendered in. If you're in a foreign currency, you have got risk. And I think this is the point which just doesn't seem to be fully understood. Now, having said that, I think the Fed and the US Treasury are waking up to the facts. They understand this. What the Fed is now trying to do is to remove the supplementary leverage ratio on the big banks, which were imposed on those big banks in addition to Basel III to try and reduce the amount of risk from banking failures in the economy. They've now turned around and said, well, of course, if we can reduce that supplementary leverage ratio, then it frees up banks to create credit to invest in treasuries. That's going to happen. But they're not going to buy anything out along the yield curve. The only things they will buy are T-bills, 3 months, 6 months, a year at most. But most of it, I would have thought 3 and 6 months. So what does that mean as far as the Treasury market is concerned? Well, it means that the average maturity, if you like, across the whole of the Treasury market is shortening, which means more and more of it has to be rolled over every year. So, we don't know how long it's going to take for this funding crisis really to hit. But if the funding crisis hits in the dollar, you can forget every other currency because the dollar is the king rat of currencies. At the moment the dollar is going down, I think there's going to be a switch in that because dollar goes down, you'll probably find that something is said which stabilizes a little bit, and then you'll see sterling going down the pan, and you'll see some traders coming out of euros as well. So there will be swings and roundabouts in this, Andy, but I think that we're in a crisis. And of course, the other thing that so few people understand is the role of gold in this. I mean, it's not gold is real money. It is actually in Roman law a corporeal asset, whereas credit, which is everything else, including currencies, is incorporeal, and you cannot cross that divide. It's actually fixed. This is the way it is in our laws and also in our logic too. Gold has no counterparty risk. It is physical. Credit is a promise to pay at some stage in the future. It's something that doesn't exist, except, if you like, on a balance sheet. So it is incorporeal. The two things are completely different. So from the point of view of a foreign central bank with reserves, of course what they do is they're selling dollars. They're reducing the incorporeal element on their reserves. It's not so much they're buying gold. They're just getting the hell out of credit. That's what it is. And I think, you mentioned, sort of quarters, sort of opposite from the timing point of view that I'm back on. I think really what we're likely to see is an acceleration of the deteriorating position of credit over the rest of this year compared to where it was earlier than this year. It doesn't look good to me, I'm afraid, as far as credit is concerned. And the other thing which everybody got wrong, and that is interest rates should not fall. Now, I can't say that the Fed and other central banks won't reduce interest rates, but they would be stupid to do so because all they do is they undermine the value of their currency. It's not going to help the funding at all. If anything, when you've got greater risk in credit, then bond yields, the coupons, the interest rate on that credit has got to rise to reflect that risk. It must do. Otherwise, nobody buys it.
The outlook for silver in 2025 appears bullish, with most predictions indicating significant potential for price appreciation. As geopolitical tensions grow and physical precious metals outperform, the quiet accumulation by states like Russia and strategic policy shifts from China suggest a historic monetary reset may be unfolding before our eyes. As confidence in the dollar erodes, will 2025 mark the tipping point when the world fully pivots towards tangible money? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.